Investor sector. These are not just rhyming words, but it's more of a love story with Indian investors carrying a mutual fund AUM of almost 2 lakh crores in sector specific funds. Banking, IT, pharma, manufacturing, energy, defense, infrastructure, it's all there. And this attraction is there because many of us believe that there are some macro plays that have a runway of 10 to 20 years ahead of it, while for some others, participating in sectors is more about tactically moving from one favorable sector to another. Now, honestly, in my opinion, there's nothing wrong with both approaches. On a trend basis, many sector-specific indices have done extremely well, with the top spots going to the IT, consumer durable and banking companies. And on a tactical basis and from a data perspective, the top 3 sectors in any year have delivered an alpha of anywhere from 25 to 70% as compared to the bottom 3 sectors, which in spite of being incredibly difficult to replicate, will give you some incentive to learn this material. And so in this video, I'll be taking you through the world of business cycles and sector attractiveness and how these can be used to improve your own investing decisions. And if you're already invested in a sector or a theme-based fund for at least 3 to 4 years, then I would love to know your experience of it in the comment section below. Let's begin. A common feature of any industrialized economy are its periods of expansion and contraction, which is collectively called a business cycle. Most of the available research on business cycles divides it in 4 phases: expansion, recession, depression, and recovery. And to put it in simple words, the economy is doing well when it's expanding and recovering, and things are not that good when the growth rate is declining or depressed. I'm sure you've read a lot about this in your class 12 NCERT book on macroeconomics, but specific to investing, here's an organized way of looking at it. The prominent clues indicating an expansionary phase in the broader economy or even an individual sector can be found in the scenario of a rising capacity utilization. So let's say a factory has increased the number of shifts from 2 to 3, or if there is a decrease in unemployment, which can also include salary hikes and even BMW bikes that were offered to some IT folks in 2021. The expansionary phase also includes a lot more capex activity, and the defense industry in India is a good example of that. And there's a lot of fiscal support as well, with low interest rates and strong credit growth. My point is, between capacity, credit, employment, capex and government policies, there are some strong indicators, some strong clues for us to be working on, and one should definitely make it a part of one's investing framework, especially when working on specific sectors. In this regards, I strongly urge you to read BCG, the Boston Consulting Group's India Economic Monitor, where every month the team there publishes statistics on some 50-60 different macroeconomic indicators. Now, just like expansion, there are specific traits to look out for when a sector peaks, when it slows down, and also when it is about to recover. So the next time you read news articles, industry reports, and even annual reports, do watch out for these clues that will tell you how a sector or even the broader economy is likely to behave over the next 2, 5, even 10 years from now. In fact, another way of looking at the same information is in terms of leading, lagging, and coincidental indicators. So leading means that the economy is doing well, which means more construction, demand is higher than supply, the inflation rate is slightly high, and there is better customer sentiment. On the other hand, a lagging scenario might mean declining GDP growth, companies are hesitant on adding capacities, there are no new jobs being added, etc. Now, in addition to this broader good times, bad times concept, it's interesting to note that the duration of these business cycles can vary from 2 to 10 years. In a lot of cases, business cycles are synchronic, which means at times of recession, the issues in one industry often get passed to the other, and the same thing happens during expansion times. To understand in which phase a sector is in, one should intently look at the capex, that is the level of investment that particular industry attracts. Similarly, the level of inventory is another clue, and generally during recessions, there's a lot of accumulated inventory. And of course, during business cycles, the profits fluctuate wildly, and this is obviously a very uncertain time for everyone. A good example of a sector that captures all these elements and phases are the heavy industries of India. So heavy industries means big, bulky products, and typically this comprises of areas like the railways, metal companies, power, water, gas, equipment manufacturing, etc. Now, in the last 2 decades, the sector has seen both an expansion phase that started in 2003 and peaked in the year 2012, and it has also had a recessionary phase which lasted until maybe last year, so 2022, and now this sector is again showing signs of revival of a recovery. The point I want to stress is that a lot of good things happened between 2003 and 2007, including a big capex cycle which resulted in high profit margins, a low working capital, excellent return metrics, and also top valuations by the time all those efforts peaked in 2012. But then starting 2013, heavy industries as a category started declining, or rather it started slowing down on account of a slowdown in GDP growth. There were no new investments coming in, environmental regulations had to be complied with, the demand from China was receding, etc. As a consequence, and what we see in FY21 is the reverse of FY 2012, and is the result of a period of stagnation that the industry went through in the 2013 to 2018 period. As a matter of fact, and it's very visible here, that what we see in FY21 is very similar to 2003, and if the government and private sector get their priorities right, then this can be the start of another phase of economic expansion, and investors can take the fullest advantage of that. So again, if you are an investor who prefers investing in specific sectors, then it's in your interest to be certain on where the current business cycle is and where is it likely to be, so that you don't have to get into a double whammy situation. That is, you end up paying a lot more for those stocks, and secondly, you'll have to go through a frustrating period of placid performance which can run into a few years. So I'm being a little repetitive here, but in my view, when it comes to sectors, an understanding of the business cycle is even more important than the examination of metrics like the ROC and the P ratio. And it's something we discussed in the video on the sugar industry, where I explained the workings of a sugar cycle and how the understanding of when it starts and when it ends can be the difference of you multiplying your wealth by 4 times or losing more than half of your capital. Now, different sectors perform differently at different phases of a business cycle. For instance, when the economy is recovering and expanding, then investments into financial companies, metal companies, and the consumer discretionary sector, so companies that are making cars, household appliances, jewelry, etc., well, investing in these sectors can be rather rewarding. Likewise, when the economy is going through a recessionary phase, then sectors like technology, utilities, FMCG and pharmaceuticals are more likely to do well. Of course, there are more factors at play like interest rate, capacity building, government policies, consumer sentiments, etc. But I hope this table here serves as an acceptable guide as to where your focus, energies and money should be at different phases of an economic cycle. Additionally, one should also take note of the fact that certain industries like IT make a large percentage of the revenue from outside of India, which means what's happening at the client's end to the US and European economy will certainly have a bearing on how this sector performs. Similarly, sectors can also be broken down into B2B and B2C businesses, and generally the intra-institutional business, so the B2B business, is a lot more cyclical, and that's something you might want to watch out for. But all said and done, it is my belief that understanding where a sector, industry or the economy is at currently is just about reading some publicly available data, and one can find a lot of it in news articles, study papers, research reports, and also in a company's annual reports, especially the section on management discussion and analysis. So this is a bit of fundamental analysis here, and if you want to learn more about it, then do explore the Fisdom Academy, which has a growing number of courses, both paid and free, including this one on fundamental analysis, where you will understand the different techniques, you learn about sector-specific industry models, qualitative and quantitative analysis, and a lot more. If you're interested, then do check out Fisdom Academy, and a link to that is available in this video's description. Alright, now that we are done with fundamental analysis, let's examine a more numerical way of identifying the more promising sectors. This particular technique comes from the team at Ambit Capital, who often refer to it as their sector attractiveness framework. So as the name suggests, the idea here is to understand if a particular sector is investment worthy or not, and there are 4 parameters that this model looks at. But before we get into that, I should mention that I found this framework a bit complicated, and I've not seen Ambit talk too much about it. Maybe it's an internal tool, and probably that's why there isn't much literature on it, but let's quickly go through what we have, and maybe there are some parts of it that we can use in improving our own investing decisions. So the first of the four variables is excess returns, and this is defined as the difference between the 12-month rolling return of a sector as compared to the broader market. For example, if you want to do it for the banking sector, then one has to use the 1-year rolling return of the Nifty Bank Index and divide it by the 1-year rolling return of the Nifty 50. Which means we are looking at relative movement of prices, and the guiding principle behind this is mean reversion. And if a sector has outperformed or underperformed the Nifty, then there is a higher probability of it reverting back to the long-term average. Like in the case of banks, the sector using this methodology has underperformed the Nifty 50 twice over the last 3 years, and these drops can be used by investors to accumulate more banking stocks. Understandably, when the same line is at the peak, then one has to be more cautious about it, and perhaps it's better to look at other sectors during those times. The second variable for evaluating sector attractiveness is relative valuation. So much like what we did for rolling returns, in this case we'll divide the sector price earning ratio over the Nifty PE, and this will be examined across different time periods, which will give us a good sense of whether the sector is relatively undervalued or overpriced. The Ambit presentation explains it with the IT sector, which was extremely overvalued in January of 2022 as compared to where the Nifty was. Again, as a principle, entry multiples matter, and that's what this variable on relative valuation is doing here, with an implicit expectation that the valuation will eventually fall back to the long-term average. The third variable in Ambit's sector attractiveness framework is called an earnings estimate sustenance, and the idea here is to look at historical trend over the last 9 to 10 years. Honestly, I'm not sure how this is exactly calculated, but from what I've read, it seems what Ambit is trying to do is to match the reduction in profits with the phase in which the sector's business cycle is. So for instance, if the IT sector is in a declining recessionary phase, then this technique tries to judge whether the cycle is likely to fall even further or if it is showing some signs of reversion. And the fourth variable is ownership, and by ownership, the framework tries to assess if domestic mutual funds are under-owning the sector, which means when reversion happens to the average, then there is a higher likelihood of the share price rallying up, and any investments in that sector can give you handsome returns. Now, Ambit uses a combination of these four variables to decide whether it is overweight, underweight, or neutral across different sectors. And it is my request, if any of you are from Ambit Capital or if you have a relationship manager attached to you, then please inquire more about this framework and do drop me an email. Alright, so let's recap what we have learned here. For instance, we now have a bunch of indicators that can let us know if the economy or a sector is expanding, if it is in recession, depression, or if the sector is in a phase of recovery. Secondly, we use that example on heavy industries as a lesson to investors to be extra careful when looking at financial metrics, as these can be at extreme highs and lows depending on their business cycle. We also broadly classified how the more popular sectors are likely to behave in different stages of the economic cycle. And we also went through a slightly complicated sector attractiveness framework on which I think a lot more research is needed. But if I have to simplify it, then what we learned includes the importance of relative valuation on an excess return and on a P ratio basis. We looked at that comparison between profits and the sector's business cycle. And lastly, the framework wants us to track where the domestic mutual funds are headed and to take action accordingly. I hope you found some parts of this video informative, and if you have your own ways to decide which sector to get into and when, then please do share it in the comment section below. Once again, thank you for your time. Do like this video, do subscribe to my channel, and I'll see you 3 days from now. Until then.